Preparing for a finance manager at Unilever interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to become a finance manager at Unilever. I have built my career across management reporting, budgeting, forecasting, and commercial decision support, progressively taking ownership of larger teams and business areas. I enjoy translating financial information into practical choices for marketing, sales, supply chain, and operations. Unilever appeals to me because its scale, iconic brands, sustainability agenda, and complex markets require finance leaders who combine control with commercial judgment. I would bring analytical discipline, curiosity, and a collaborative style while developing people and improving business performance. While answering, focus on your progression, commercial finance experience, leadership style, motivation for Unilever, and connection to purpose-led brands, disciplined performance management, and cross-functional business partnering. Question 2. What do you understand about Unilever's business model and key financial drivers? Unilever operates a global portfolio of consumer brands across categories such as beauty, personal care, home care, and foods. Its key drivers include underlying volume growth, pricing, product mix, brand investment, input costs, productivity, foreign exchange, and working capital. I would also assess performance by category, channel, and market because growth quality differs substantially. Strong finance leadership means protecting long-term brand equity while ensuring pricing, cost control, and resource allocation deliver sustainable margin and cash improvement. Make sure to cover brand strength, volume and price, mix, emerging markets, category dynamics, gross margin, advertising investment, working capital, foreign exchange, and the balance between growth and productivity. Question 3. How would you build an annual budget for a Unilever business unit? I would begin with the strategic plan and translate it into operational assumptions by brand, market, channel, and function. Revenue would reflect volume, price, mix, distribution, and promotional activity. Costs would include raw materials, logistics, advertising, people, and overheads with explicit FX and inflation assumptions. I would run challenge sessions with commercial and operational leaders, create upside and downside scenarios, agree accountability, and establish monthly variance reviews so the budget remains a management tool rather than a static submission. In your answer, talk about strategic alignment, bottom-up assumptions, historical trends, volume price mix, marketing plans, supply chain costs, scenario analysis, challenge sessions, ownership, and monthly performance tracking. Question 4. How do you explain a significant actual versus budget variance to senior stakeholders? I first quantify the variance in separate timing, accounting, and genuine performance effects. For revenue, I would analyze volume, price, mix, promotions, and foreign exchange. For costs, I would examine rates, efficiency, inflation, and timing. Then I would validate the story with the accountable business owner and assess whether the issue is temporary or structural. I would present the cause, revised outlook, financial consequence, and specific actions, keeping the discussion objective and focused on decisions. Be sure to mention materiality, root cause analysis, volume price mix, timing versus structural effects, ownership, financial impact, corrective actions, and a clear communication style focused on decisions rather than blame. Question 5. How would you forecast sales for a fast-moving consumer goods category? I would start with a baseline forecast using historical sales, seasonality, distribution, channel mix, and recent trends. I would then overlay planned pricing, promotions, innovation launches, competitor activity, and supply constraints. Commercial and supply chain input is essential, but I would challenge unsupported optimism using evidence and scenario ranges. After each cycle, I would measure forecast accuracy and bias by brand and market, learning whether errors came from assumptions, execution, or external events. Focus on statistical history combined with commercial intelligence, baseline demand, promotional uplift, distribution, price elasticity, innovation, seasonality, channel trends, and forecast bias measurement. Question 6. Describe how you would manage gross margin pressure from rising commodity costs. I would quantify the exposure by material, product, market, and timing, then distinguish contracted costs from future risk. The response should combine pricing, pack architecture, mix improvement, procurement action, manufacturing productivity, and where appropriate, hedging. I would model elasticity and competitive reactions before recommending price increases. Finance should coordinate commercial, procurement, R&D, and supply chain actions, track benefits monthly, and protect long-term brand trust rather than relying only on short-term cost-cutting. Cover cost driver analysis, pricing, pack and product mix, hedging, reformulation, procurement savings, manufacturing productivity, demand elasticity, customer negotiations, and protecting both margin and consumer relevance. Question 7. How would you evaluate whether a marketing investment is generating an acceptable return? I would compare incremental contribution, not simply reported sales, with the full investment cost. That requires establishing a credible baseline and isolating promotional, distribution, pricing, and media effects. I would use test-and-learn approaches, market comparisons, econometric analysis, or post-campaign studies where available. I would also recognize that brand investment can have a delayed return, so I would combine short-term commercial metrics with awareness, consideration, and market share indicators before reallocating funding. In your answer, discuss incremental sales, contribution margin, baseline versus uplift, media effectiveness, lagged impact, cannibalization, customer data, test-and-learn methods, and long-term brand value. Question 8. Tell me about a time you influenced a non-finance stakeholder to change a decision. In a previous role, a sales team proposed a promotion that appeared attractive on revenue but reduced contribution after funding and cannibalization. I listened to their volume objective, rebuilt the analysis by customer and product, and offered a narrower promotion with better margin economics. We agreed to test it in selected accounts and review results weekly. The revised plan achieved the required customer volume while improving contribution, and the process strengthened trust because finance enabled a better decision rather than simply rejecting the proposal. Make sure to cover the business context, stakeholder objective, evidence used, listening and relationship skills, alternative options, quantified impact, agreed decision, and measurable outcome. Question 9. How would you improve working capital in a consumer products business? I would first diagnose cash tied up in receivables, inventory, and payables by customer, SKU, location, and aging. Actions might include improving collections, tightening credit terms, reducing slow-moving stock, improving demand accuracy, simplifying SKU complexity, and negotiating supplier terms responsibly. I would never pursue cash blindly at the expense of service or supplier resilience. Clear owners, weekly metrics, and cash targets embedded in operational reviews would make improvement sustainable rather than a one-off balance sheet exercise. Discuss receivables, inventory, payables, cash conversion cycle, service level trade-offs, SKU complexity, demand planning, customer terms, supplier relationships, and ownership through operational metrics. Question 10. What financial controls would you expect to see in a finance manager role? I would expect controls covering authorization, segregation of duties, system access, master data, purchasing, revenue recognition, journal entries, balance sheet reconciliations, and period close. Controls should be risk-based, clearly documented, evidenced, and periodically tested. If I identified a failure, I would assess the financial exposure, contain the immediate risk, determine the root cause, and agree a sustainable remediation plan. Strong controls support reliable reporting while allowing the business to operate efficiently and make timely decisions. Be sure to mention segregation of duties, approval limits, reconciliations, journal controls, master data, access management, close procedures, documentation, risk assessment, and remediation of control failures. Question 11. How would you manage the month-end close and ensure accurate reporting? I would establish a close calendar with defined owners, dependencies, review points, and escalation timelines. Key areas include revenue cutoff, accrual completeness, inventory, provisions, depreciation, intercompany balances, and balance sheet reconciliations. I would use materiality thresholds and analytical review to focus effort on meaningful risks, while standardizing recurring journals and automating reconciliations where possible. Before reporting, I would challenge unusual movements, confirm explanations with business owners, and communicate both results and emerging issues clearly. Focus on a clear close calendar, materiality, reconciliations, accruals, cutoff, intercompany balances, review controls, issue escalation, automation, and communicating results within agreed deadlines. Question 12. How do you approach international financial reporting standards, reporting issues, and accounting judgments? I begin by understanding the substance of the transaction, its contractual terms, and the relevant international financial reporting standards guidance. I assess materiality, identify judgment areas, gather supporting evidence, and involve technical accounting or auditors when the issue is complex or high risk. I document the conclusion, alternatives considered, and controls required for consistent application. My objective is not merely compliance. It is a transparent, well-supported answer that management, auditors, and future reviewers can understand. Cover understanding the transaction, relevant international financial reporting standards requirements, materiality, evidence, consultation, documentation, consistency, controls, audit dialogue, and explaining technical conclusions in commercial language. Question 13. How would you assess the financial impact of a new product launch? I would build an integrated launch model covering market size, distribution, price, volume ramp, gross margin, trade investment, media spend, manufacturing requirements, working capital, and cannibalization of existing products. I would separate fixed and variable costs and test downside cases for slower distribution or weaker repeat purchase. Approval should include clear milestones and KPIs. After launch, I would compare actual demand, margin, and cash performance with the business case and adjust investment quickly. In your answer include market size, assumptions, price, volume, cannibalization, trade spend, marketing, manufacturing capacity, launch timing, working capital, scenarios, and post-launch review. Question 14. What would you do if sales were ahead of plan but profit was behind? I would not assume that higher sales represent better performance. I would build a profit bridge covering price, volume, mix, discounts, customer investment, product costs, logistics, advertising, overheads, and one-off items. A business may be selling more low-margin products or buying growth through promotions. I would identify the largest drivers, validate them with commercial and supply chain teams, and recommend actions such as mix improvement, pricing discipline, cost recovery, or stopping unprofitable activity. Discuss revenue quality, discounting, mix, trade spend, input inflation, logistics, product cost, advertising, one-offs, bridge analysis, and actions to improve profitable growth. Question 15. How do you lead and develop a finance team? I set clear priorities, define ownership, and connect each role to the wider business outcome. I use regular one-to-ones, constructive feedback, and tailored development plans covering technical skills, communication, and commercial exposure. I also encourage team members to present insights directly to stakeholders, building confidence and visibility. High standards matter, but so do psychological safety and recognition. My aim is to create a team that delivers accurate work, challenges constructively, and develops successors. Make sure to cover role clarity, coaching, regular feedback, technical development, business exposure, psychological safety, performance standards, succession planning, and adapting leadership to individual needs. Question 16. Describe a difficult conflict with a stakeholder and how you resolved it. I once disagreed with an operational leader over an expense forecast that I believed understated committed costs. Rather than challenge the estimate publicly, I met privately to understand the assumptions and reviewed contracts, purchase orders, and historical spending together. We identified several commitments missing from the forecast and agreed a revised estimate with ownership for monthly updates. The conversation remained constructive because we focused on decision quality and shared accountability, not on proving one person wrong. Focus on listening, separating facts from assumptions, maintaining professionalism, clarifying shared objectives, using evidence, agreeing decision rights, documenting actions, and preserving the relationship. Question 17. How would you use data and technology to improve finance performance? I would begin by identifying repetitive, manual processes and unreliable data sources, then prioritize improvements based on risk, effort, and value. Standardized master data, automated reconciliations, and dashboards can improve speed and consistency, while exception reporting lets finance focus on unusual movements. I would involve users early, document controls, and measure adoption and time saved. Technology should not simply produce more reports, it should create better insight, stronger control, and more time for commercial decisions. Discuss data quality, automation, dashboards, ERP discipline, self-service reporting, exception-based review, process controls, user adoption, and freeing finance capacity for analysis and business partnering. Question 18. How do foreign exchange movements affect Unilever's financial performance? Foreign exchange affects transaction costs, translated revenue and profit, balance sheet values, and cash flows. I would separate the economic impact from translation effects and explain reported performance alongside constant currency results. The analysis should identify currency mismatches between sales and costs, hedging coverage, pricing responses, and exposure by market. For example, a weaker local currency may increase imported input costs while reducing translated results. Clear disclosure helps management distinguish underlying execution from external currency volatility. Cover transaction and translation exposure, revenue and cost currencies, constant currency analysis, pricing responses, hedging, emerging market volatility, cash flow, and communicating underlying performance separately. Question 19. What would you do if you discovered a material reporting error shortly before the close deadline? I would first validate the error, quantify its income statement, balance sheet, cash, and disclosure impact, and determine whether any prior periods are affected. I would immediately escalate it through the agreed reporting and control channels rather than conceal or delay the issue. If correction is required, I would coordinate the entry, evidence, review, and audit trail while protecting the close deadline. Afterward, I would investigate the root cause, strengthen the control, and communicate lessons learned to the team. Be sure to mention immediate validation, materiality, containment, escalation, correction, audit trail, stakeholder communication, deadline management, root cause analysis, and preventing recurrence. Question 20. Why should Unilever hire you for this finance manager position? Unilever should hire me because I combine strong financial control with practical commercial judgment. I can lead a disciplined close, build credible forecasts, challenge assumptions, and translate performance into actions for non-finance stakeholders. I also bring experience developing teams and improving processes, not just producing reports. My style is collaborative, curious, and accountable, which fits a global consumer business. I would help Unilever grow responsibly by connecting brand investment, operational execution, profitability, cash, and long-term value. In your answer, summarize technical capability, commercial judgment, leadership, integrity, stakeholder influence, consumer business understanding, measurable achievements, and alignment with Unilever's purpose and performance culture. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.